General advice warning. This information is of a general nature only and does not take into account your objectives, financial situation or needs. You should consider the product disclosure statement issued by Plantation Capital Limited in deciding whether to acquire an interest in the passive income USA Commercial Property Fund. Past performance is not a guarantee of future performance. No earnings estimates are made. Part 3. Why USA Property? Look, there are a number of reasons why I believe that USA property is amongst the hottest investment opportunities on the planet at the moment. And chief among them is simply being able to take advantage of market momentum. In the United States of America, and certainly in some cities and some properties, prices fell by as much as 60 or 70%. And the market cycle there seems to, again, not everywhere, but in certain select cities and places, to have bottomed and is recovering. And so what we want to try and do is make the market momentum our friend, and rather than invest against the momentum of the market, to take advantage of it. So if we're buying in prices where assets have fallen so much, once the conditions that cause those assets to fall are no longer there, it's reasonable to expect that prices will recover. And so instead of being able to control market forces, which we can't do, what we can do is choose to position our money so that it can take advantage of the maximum possible market momentum. And I believe that the US commercial property market is such an opportunity. If we look at what the experts say, and included in the product disclosure statement is a report by CRE Consultants, and its conclusion includes this wording. The Great Recession may have technically ended in 2009, but the effects of it are still reverberating throughout the domestic and commercial real estate markets. Nonetheless, in our opinion, the window to create significant wealth via commercial real estate as a result of declining values created by the Great Recession slowly closing. Interest in commercial real estate, both from investors and tenants, is generally improving, albeit access to finance is stunting potential buyer demand. As evidenced in this report, commercial properties continue to be listed on the market at varying discounts, depending on the use, geographic location, and level of distress. Investors with access to sufficient capital have the opportunity to acquire a diversified portfolio of quality US commercial properties that deliver income returns now, with the prospect of capital gains in the medium term, if the housing and labour markets recover as expected. So aside from the timing and taking advantage of the timing in the market cycle in the United States, hand in hand with that comes the potential for growth as markets recover. And if we take a look at one of the case studies that's included in the product disclosure statement, this 33,000 square foot building, trying equivalent is a 3,300 square metre building in Fort Myers, which is for sale at $899,000. A little bit of scratching behind the scenes shows that for council or county rates or property tax purposes, this building is valued at $1.6 million at the moment. So it's sort of for sale at about, well, not half, but close to half its current council value. And then at the peak of the market, it was worth around $4 million. So an asset that was worth $4 million is currently worth $1.6 million, is for sale at $900,000. And it gives you some idea of how asset values have fallen off their peak and the opportunity to acquire high quality assets at reduced prices. I mean, imagine what this building would cost if it was in Australia. It'd be far more than $900,000. The mix of assets that we're going to look to acquire as part of the US REIT is as follows. So properties backed by high quality long-term tenants on triple net leases, those being leases where the tenant agrees to pay all or most of the real estate taxes, building insurance and maintenance costs. So what we can do here is put in to the US REIT properties that are going to deliver a reasonably constant return. They're on long-term leases, good quality tenants, and we'll put up to 50% of the money into assets such as that. Then we're going to try and also add a mix of properties that can be broadly managed as a commercial venture but have a residential component. Things like apartment complexes and mobile home parks that have higher yields and therefore can increase the return that we're able to achieve as income distributions. Then we're also going to add in properties that are considered distressed but which provide the ability to offer income and scope for capital growth through value add undertakings such as refurbishment, subdivision, etc. So these type of assets are the high growth assets that we can use our skill and expertise to manufacture. And then lastly, we'll retain some money as cash and money market instruments to have liquidity in the fund, and also just to manage our cash position. So the third aspect then is the scope for income. So I've talked about the scope for property prices going up. There's also the scope for rents going up as well, as and when the US economy recovers. We have Australian dollar buying power. And if we take a look at a graph of what's happened to the Australian dollar since it was floated in 1983, you can see there's only a small window over the past nearly 30 years where it has been above parity. So looking at historically whether or not now's a good time to buy US commercial property, well, only sort of 10 to 12 years ago, one Australian dollar bought less than 50 cents. Now it's buying around $1. So we have tremendous buying power historically. And if you were ever looking at buying US commercial property, I would have thought that given low prices and given the buying power of the dollar, now would be as good a time, or perhaps even the best time, as any other time in the previous 30 years. We also have the potential for foreign exchange gains. Let's take a look at an example. If we had our minimum subscription amount of 20 million and we sent it overseas at parity, then we'd end up with 20 million US dollars. If the Australian dollar fell to 80 US cents, then we could, if we liquidated everything, bring $25 million back. In other words, as the Australian dollar goes down, the amount of money in the fund comparatively goes up if we were to bring the money back. Secondly, also, aside from the capital value, is the rent. If we were to collect, say, $1.2 million of rent each year and the Australian dollar fell to 80 cents, then the Australian dollar equivalent when we brought the money back would be $1.5 million. And so our yield would be increased. Of course, it's not all upside. If the Australian dollar appreciated against the US dollar, then it would be disadvantageous. But what do you think is more likely to occur? Do you think it's more likely that the Australian dollar will continue to go higher, or do you think the Australian dollar may return back to its longer term average? Well, if you believe that the Australian dollar is going to return back to its longer term average, then an investment such as the Passive Income USA Commercial Property Fund would deliver you increased returns in the form of foreign exchange gains. So a little conclusion to this session. What we're trying to take advantage of by investing in USA property is the market cycle momentum working for us rather than against us. We have superior Australian dollar buying power. We have the scope for an increase in price and also an increase in rent. And we also have the ability via management expertise to spot opportunities and solve those problems to manufacture profit in addition to whatever happens in the market. And finally, there's also the opportunity for foreign exchange gains if the Australian dollar goes down against the US dollar. If you have any questions or need further help, please get in contact with me. You can call me in the office 03 8892 3800 or contact me via email steve@PropertyInvesting.com.